Why you want to watch this video about group structures for property investors. It will give you all the insights on how you combine it with stuff like family investment companies. Check out this video. Group structures. I want to cover this because for me, if you are sophisticated, and I've done a few of these, group structures are massive. And I'll explain why. So you've got group structures. And I think the Q&A on this probably will be useful for everybody because this will cover loads of things, right? So when I talked about FICs, family investment companies, make the parent company a FIC. This is for investments, yeah? Trading has got total different rules as well. Potentially in the future, you can add them in, right? The reason why you have this, it gives you asset protection. There is benefits and limitations on this, right? So the benefits are, one of the issues is VAT. Has anyone come across VAT? You're doing commercial property, service accommodation, furnished holiday lets, any of that stuff, right? So always have them split. And anyone tells you otherwise, sorry, VAT is the most complex tax. And we have a lot of that, and we've got specialist VAT people. Got quite good knowledge on it as well. Do not combine them because you need removal from HMRC. That's also within a SAS, by the way. So anyone tells you otherwise, they don't understand, they're not a tax advisor, they don't understand partial exemption VAT. Because generally property is not VATable. Yeah, that's the default position. Commercial property is different, anything short lets, it changes. And it's complex, so you have to agree special requirements. So what I tend to say to people, to keep it easy, in simple terms, VAT, non-VAT. Yeah? If you do that, that's one huge benefit. Why I said make this a FIC, the holding structure, you do it once. You know, because then you don't have to keep on doing them and paying loads of money and all this complex. And then what you can use is, everyone knows dividends can move tax-free between the company. Why is that important? Does anyone know? Apart from the tax saving on that?
And offset losses, I think. On the
that's a separate thing, but it's a good point. We'll get onto that. But the dividends, why it is asset protection. The parent company should just own the shares and cash. Really important. If I cut your head off, disrespect, no anyone here, I'm not going to survive, am I? That's your holding company. If I cut your hand, painful, not nice, but I survive. That's these.
Right.
That's why if you're sophisticated, you've got to start doing, yes, you can transfer losses. The magic rule is at least 75%. So someone mentioned JVs. This is how we do JVs. Yeah? If you don't get the advice on joint ventures, you're going to get hurt. 75% rule is very important. If one parent company doesn't own 75%, you can't move assets around and do loads of stuff. You're going to get hammered on SDLT, potentially corporation tax for the gain, potentially VAT as well. We normally have these. If you're doing title splitting, anyone done title splitting? Educate yourself.
Yeah.
Do it properly.
Expensively, make mistake. Yeah.
Right. I'm going on a specialist actually, because the reason being is we know the council tax. A lot of people come, but you've got to get the right lawyer and financing because they can balls it up, and the surveyor. If they don't do it properly, it can cause you a lot of land registry problems. So there's loads of impacts, right? But what happens is, so I'll give you an example. We had a client who bought a £4.5 million property. We saved him 1.1 million in tax on the acquisition, 900k VAT. At that time, stamp duty was about 80 grand if I remember right, and corporation tax was 125k. That was just on the acquisition by understanding group structures. And then we saved again on the split. The person phoned me back about 2 months ago. This was 2-3 years ago. He said, oh, see, got great, I've got an investor wants to buy the block. I said, all right, how much are you looking at? Because you know I've got on the top airspace. Does anyone understand PD here, planning? Right, so, okay, so PD, you can do airspace, can't you? So this is different to tax, but it's impacts, yeah? Because of that asset, you spend a few million, I think 2 or 3, how much asset do you reckon that's worth on the market now?
bought 2-3 years ago now.
2
value.
years, yeah. Spent a couple of million on it.
Doing what?
2, 3 refurbs and all the rest of it.
With no
Done
airspace
split,
development.
no airspace.
10?
No. Good question. Good answer. Potentially.
Depends if you bought it cheap or not, I guess.
No, you didn't actually. You 4.5. You had to do a lot of work on it to get up to date. It's going to be worth. He reckons about 23, 25 mil, and that's after airspace. So he probably could sell it. I said to him about 15 mil. Right. So he's doubled his money in 2 years. And the reason why I'm saying the only strategy that I've seen from entrepreneurs, I'm privileged that I meet so many forward-thinking entrepreneurs. I'm going through the scales here because this is quite advanced, right? Is as you go up, there is no competition after a certain point. The hardest point is 1 to 5 mil. 0 to 1, sorry, is hard. 1 to 5, I'm talking about GDV, gross development value. Above that, the competition goes away and you can pick. And that's why now the real estate investment, like BlackRock, I was talking about FX and all that, who are they coming after? They want to buy blocks. And the reason why they're buying blocks is something called a REIT. I did an episode on Sky on this. It's a different world, but basically they pay no tax. So they've got a special limited company that they can do and pay no corporation tax on residentials. If it's 90% of special rules. And this is what our governments are doing. So you've got to just not cry about it, learn the rules. So they're buying, so you can, when you're dealing with them, you know, they didn't go for it, but you could easily got 15 million because they can do the development because of PD on airspace. Do you see what the opportunities are massive? And this is how people scale. This is the only tool that you can really use in the UK to achieve what I'm talking about. So if you haven't got one of these and you're moaning about accountancy fees or all this, you're not a forward-thinking entrepreneur, in my opinion, because you have to. Otherwise, when you do title splits and all this stuff, it don't work. You can't do it because you're going to trigger taxes off. You save all these because you can get exemptions for groups and all sorts of stuff, right? You can get VAT benefits depending on when you do it. So I've got a client now doing a project where they're converting. And I'm like, you need to do a group stroke. Oh, God, I might have to pay a bit more fine. I don't care. Yes, so, but you're saving millions. So, like the mindset of some people 10 years ago was different. You have to go with the times. So you've got to factor in the cost of financing, all the accounts, whatever. Am I getting overall benefit? Is it going to get me to the end point quicker? And I think the only strategy probably in the UK, I think because commercial resi conversions are hard in the 0 to say 3 mil bracket now, too much competition, and everyone bakes in the resi, so you don't get the money. The blocks are huge. So if you do those and you get good ones, if you do a mixed, even better. I'm going to go on to something called capital allowances. Everyone used those?
Yeah.
I mean,
Heard about it, but not used.
Have you used capital allowances? You don't mind.
Mainly on common areas within blocks
Yeah.
and around service accommodation.
Yeah, they've stopped the service.
Yeah.
Well, have they? That's a different
Well,
question.
I suppose, yeah.
If-
He did it a few years ago.
So they stopped in March 2025, but that's for C3. Yeah?
Yeah.
C1 is different, isn't it?
I don't know. I had a C3 building which had Airbnb use and they came.
I would be looking at changing that.
Yeah, I'm trying at the moment.
Yeah, because, so sorry, we're jumping to planning. You have to know all of that to do what I'm talking about, because it goes, you've got to get lined up. Planning, all of this is so relevant because it all falls over if you don't line all of it up. So you need the team. And someone switched on, goes back to accountant tax advisor, because if the numbers don't stack up, you can't do the project. Capital allowances are really good. Do you know what types of capital allowances? I'm going to just do that and then do a Q&A. I sort of touched this. There's loads more on this. It goes on forever. Capital allowances are when I buy a commercial property or a property for commercial use, emphasize that, like care homes, etc., etc. On the purchase, potentially I can claim a percentage of the value of the property. I can actually earn £1 million tax-free, don't fall off your chairs, still in the United Kingdom, as we speak in April 25, or June 25, I should say, right before Rachel carves that up. Because capital allowances is a cash flow and a tax benefit. Capital allowances is like, in the UK we don't get depreciation on the property. Dubai you do, different world. Here, I don't know what's wrong with us, but we don't do depreciation. That's a big problem, isn't it? Capital allowance is a version of that. And you can then claim what's already in there, the circuits, all this. So you need the tax advisor to look at the CPSE, make sure they plan for all of this, capture all of that. Then you can claim on the refurb, do it in that order again, yeah? But the refurb has got very complicated rules on if you ever sell the property, from VAT and corporation tax. I didn't want to get into too much details of tax because people will get overwhelmed and they'll be like, what is he going on about? Because it is complicated, but I'm just giving you the opportunities, because if you don't have all of these in the toolbox, you're just throwing money away. Most of the people I meet throw loads of money away, and they get angry, but it's not angry. Don't get angry, just get even and get your knowledge up and then implement. Do you know what's happened is happened? Yeah? So when you buy property, always get an evaluation. Even if it's a quick call with your accountant who understands property, because you could be missing stuff on SDLT, VAT, corporation tax. How am I structuring? All of that. This is what I go on about on LinkedIn all the time, if I bore people. So I think I've covered CAs as well. Yeah, and it can build into losses across here, and you can do loads of fun stuff. Q&A. Is that sort of covered this? I've run through all of this because we've run out of time.
Yeah.
Go on, pass that over. By the way, I've enjoyed this conversation. You guys are very good. I like it. Go on.
Hi, Tom again. Just a question about how this therefore ties in with inheritance tax. I think I don't think I've got a FIC, but I've got a group structure. I have 3 different share classes, A, B and C.
That's not the FIC.
Exactly, I don't think it is a FIC.
We need an evaluation.
As it stands at the minute, but the principle behind that setting it up was that I could hand shares to my children. They're currently owned by my wife and me. Different structures, if that make different classes.
What are the subsidiaries?
As in, what are underneath them?
Yeah.
I got a company that owns the property. And develops it. I've got a lettings business, and I've got a private medical business.
Because they're trading businesses.
Some aren't, I guess. Yeah.
This is where the thing is, you need an evaluation, because they got more stricter. Before they used to do on revenue. Now there's a whole lot of tests whether the group structure becomes an investment or a trading structure. Yeah. Trading we haven't covered here, has different types of benefits, and one of them is called gift relief, because when you gift it, you have to be able to claim the relief. You can't claim it if this is an investment, because investments are not part of gift relief. If the overall business, so there's specific tests. There's like a 20%. If more than 20% is investment, and there's a whole lot of tests, more than 50% IHT goes, CGT goes. You need the CGT to be able to claim gift relief. Yeah?
Okay.
I know I've gone through it quick.
No. Yeah, it needs a bit more thought, doesn't it?
Yeah, because you can't just give shares away, and also the age of the children is really important. Are they over 18?
No.
So you can't do it. You can't do it anyway because of parent settlement rules. Without, it's not part of this. There's a grandparents and all the rest of it, and we do all of that as well. But that's right at the beginning, not for established businesses, because you have to value them, and they've proper. Yeah. There's a spotlight called 62. Check that out. That's HMRC spotlight. If you don't do them properly, the grandparents, and that's why you can only really do it at the beginning, in my opinion. Everyone's got their own opinions of grandparents' angle, but if children are under 18, they can't be shareholders, and if you gift them shares, there's an issue with there, but also the income comes back to the parents over £100, and that should be covered when you speak.
What about when they're over 18?
Over 18, it depends on trading status then, because when I give shares to anybody, bar being a husband and wife or civil partnership, I trigger capital gains tax off. Yeah. So I have to claim an election and represent to HMRC to claim something called gift, and that only applies to trading businesses. Yes. And if it's not trading, which most of you guys will, I can't do that. That's why we do the FIC in the way we do and all the rest of it, because it's to stop capital gains tax in your lifetime and inheritance then after your lifetime. Those taxes go together, and some called stamp duty on shares as well. So there's a lot of, like these things, you've got to literally think about every different implication. What does that mean? Yeah. right? And unfortunately, if you go to a GP, they're just there to do your accounts, man.
No, I agree with that.
And the accounts are important. Don't get me wrong. I'm a chartered accountant. They're important, but they are not. The tax and accounting is different. The accounting is really important for performance and management. And management accounts so many benefits. Forecasting, which is more business advice, business coaching run than accounting. The tax is also important about current circumstances. How do I manage my exposure? Do my plans and what my legacy and my future is, and structure it and know what the implications are. Timing is so important, and it's getting that advice.
It's a tough one though as well, because you're having to balance this all out with what's your access to lending and the fix and things like that. It really does.
But if you get it's a good point. But I think if you get the right team, you can manage it, because what I've talked about, all this stuff, this isn't new. Yes, it's had to evolve and mend with the stuff, but that's how everything is. Because tax is like, I've got this room. As soon as everyone knows where the door is, that door gets stuck, new door opens. Because we've still got rich people living here, haven't we? So they need tools, otherwise they ain't going to stay here. And I'm saying open because it's on YouTube, you can hear it. Sorry.
I was just looking at
Do you want to get the... Sorry, say your name and bit. Sorry, Nicola.
I was just looking at the list of questions everyone had sent beforehand. I think the only one we've not covered is maybe Dave's JV stuff. I do have a question, which is very quick, about people who pay school fees. So, and maybe it's specific advice that maybe I can come and talk to you about separately, but where you've got a sort of structure and you want to pay fees, presumably
So the school fees is a common question, right?
Yeah.
This goes back to, I think we touched on it, the grandparent spotlight 63.
Yeah.
It's really when you start, how you structure.
Yeah.
Once you've got ongoing business, it's done on a net present value NPV basis, and when you look at that, the valuations, they're just not worth it.
Yeah.
So, because what you do is you pay out dividends. You don't offset it, it comes here, right? And the kids can be beneficial owners, not legal, but it's done at the beginning. The only way we would plan, because of the tax implications of CGT and something called an indirect parent settlement. And that was what's mentioned in Spotlight 63. And look, HMRs have been upfront for once on that. So look, it's not something I would recommend doing once you've got something going. If you did it at the beginning, we've done a few, because you can do it with the grandparents and all the rest of it. It can be really beneficial, but it depends on your circumstances. And be really careful, because they do check everything, and now they're checking about beneficial ownership, because you have to report the trust. From, I think it's 2021 that you've got to report. Have you heard about trust reporting service?
No.
Right, make sure, and there's something called employment related securities. They've introduced loads of general avoidance stuff that you've got to be careful, and that's got to be covered when you do any of this type of planning.
Okay.
I hope that's sort of giving you insight there. Who was JV?
Dave.
Right, let's do the JV, and I've got to finish on this, if that's all right.
Yep, so Dave here. So I've got a few SPVs which are joint ventured, 50-50. Some of them have my main SPV as a parent company, others have individuals as 50% ownership. I think through listening through quite a lot of this, I probably would have had to have had a better strategy at the point of formation, but it was about how does IHT apply to joint ventures. I guess it all comes down to the shareholders agreement.
So it's a IHT question rather than a structuring question, or both?
Well, it's both. Really, isn't
it? Okay, so JVs, I would have had the investment done from my parent always. Yeah, they own the shares, not me in my own name, because then it helps with movements of profits and all the rest of it.
Yep.
And assets, as I said, it's over 75%. Regarding IHT, it depends on what the company is doing, right? If there's a property investment vehicle, then depending on your shareholding, you've got an IHT exposure, and that's a problem now. Does that make sense? So if I've got 50%, then I've got 50% of the net assets on death.
Okay.
I emphasize net assets. So think about that.
Yep.
Yeah? Debt is a friend if you use it properly. Yeah, so because then you can do stuff on that, provided. The thing is, the shareholder agreement, by the way, that's a legal aspect, so important. And I think you've raised a really important thing. So many people don't do it. Oh, if you're doing someone that's not your wife or husband or partner, even that some people argue, but that's their choice. Got to get one of those, because someone wise said to me, and I always love the people that are a few years ahead of us. They've got wisdom, right? So you've got to listen to them. And he said to me, listen, Z, when you start your business, you get a shareholder agreement if it's not, intimate people like you're close to, or even if it's friends, and you put it in the top drawer. The day you look at it, say that agreement's over. Did you understand what I mean? Put it in the top drawer. As soon as you look at it, it's finished. And that's one of the best pieces of wisdom I've ever had. Yeah. So think about that. Do not leave things to chance, because everyone's memory remembers things differently, and led to their favorability and not. So if you have it written at the beginning, this is what's going to happen, it's worth the investment. I know it's not tax deductible, but shareholder agreement, but it's worth doing. And I save so many arguments because you know what's going to happen.
Yeah.
And
a lot of money as well, potentially.
yeah, and especially when you're in property, because the assets are huge. Go on, last one, go on. I know
Really
Sarah,
quick
go on.
one. What are the setup costs and admin costs for a FIC?
We do an evaluation, do a consultancy, and then we do an evaluation on what you want, right? And then what we quote for that. So a FIC, normally you're looking at probably 15 to 20k for a FIC.
15 to 20k.
Yeah, that's
to
including
set up a
VAT.
FIC.
It depends on how complex it is,
Okay.
because it depends how many generations you're going down. That includes accountancy, tax, legal, review of the financing, because please do review. Any of these people that don't get a lawyer to review the financing, you'll open yourself up, because they are looking at company house now, post-COVID. They get an email shot and then they start phoning me and saying, oh, the shareholding's changed, this, that, oh, you're in breach of all these. You don't want that. So they've got to look, are you allowed to, and then have that conversation. And that's where your broker and all this is so important, because if they don't know it and you go and do it and you've got debt, you're going to have some problems, because it's like talking to the brick wall, isn't it? Computer said no, but they don't even know, and it just requires a direct issue. This is what we're doing. Z or someone jumps on the call. This is what we've done. Oh, right. Everyone's done it. Fantastic. Bam, bam, and it's done. But if you haven't got that relationship and you just did it off the internet or a broker thing, we've got no, I'm sorry, but you're going to have some shocking news. So those are the things, 4 areas: accountancy, tax, legal, financing, generally for FICs. Before you do anything, then you get an evaluation assessment or part of that, and then what it meets and what requirements you need. You need to think, and that's what I think, I know we were going back on the family investment company questions, right? But you need to have an understanding, what is the legacy, who's getting what, and when it's getting. It's worth the investment, because you're now saving potentially millions, and it can go into the tens of millions depending on how big. Get it done ASAP, my recommendation, but everyone to do it.
Part figure on an appraisal?
Appraisal? Well, we just do a £400 consultation, and then I'll go through all the facts. And we normally have 2. So we do the consultation. It's on my website, go and have a check. GoldHouse Accounting, Alfie, if you get an email to Nicola over, she sends a message and we'll do that. Get that, but I'm just giving you the stuff to get before, and then we have to get all your assets in the company, net assets, if it's an LTD, where the properties, what's the issue, right? Because remember, this is one part of the jigsaw, It's not the only part. You've got to get them all lined up. So you've got this bit, and then we have some kind of roadmap session, right? We do that, we charge about 1,500 quid, but that's 3 hours, you have to come to office. Zoom don't work for that, right? I'll be honest, but you need to think, where am I going to 5-10 years from now? And then we document, because what happens is, this is a tactical, do you know the difference in strategy, tactical and operational? You're doing operations right now. This is a tactical, but the strategy hasn't been done. To do a strategy, I need to know a lot about you and then we need to get specialists in different parts to do stuff. And this is the problem in a lot of this stuff, because people just do tactical, oh, I'm done now. But hold on, did you get this part done, this part? Oh, no one talked to me about that. So you've got to try to think, where 5-10 years, I know it's not easy, but that's what you've got to do, and say, look, what am I going to do first? Because you can't do everything at once. Right? And then how does my annual plans look against that strategy? Where's my exit looking? Where am I going? What is that? And then sometimes you need multiple people as well, just on the tax side, because if you're going to non-Dubai, for example, you need a tax specialist in that country. What's the implications? Because you don't want to go from pain to more pain. Like people going to France, and Spain can be painful as well. Portugal used to be good. Malta's not bad. Cyprus, I'm just from people where they've gone. Cyprus was good until recently. They're getting a lot of people they don't want there, a lot of issues. So things are changing rapidly. So wherever you go, you've got to like it, if that is one of your strategies.
And what's the ongoing admin fee? So you mentioned 400 consultation, 1,500 for roadmap consult, 15 to 20k to set up the FIC, and then the admin costs.
It depends on what you're doing for your packages. They're more accountancy and what you need on an annual basis and forecasting. We do that. We don't charge we do quotes for clients on those. But they map into your strategy, right? So they're more accountancy, tax, and what planning you need. Most people, depending on where they are, they need a forecasting planning session with myself. Very valuable because in the UK, believe it or not, you pay corporation tax and tax on what you, if you plan, on what you want to pay. Still. And people don't understand that. Tax, someone said to me, death and taxes, and I will finish on it. No, I can't help you with death, unfortunately, that's outside my hand. Taxes, yes, they're not guaranteed. It depends on what you're doing. I did that on Sad Hussein's podcast, watch that. Consumption generally leads to tax. Deferred consumption does not lead to tax. Knowing pre and post, I think I said it at the beginning somewhere. I think we covered loads. Is that being useful?
Very useful.
Okay, perfect, thank you. I can end the YouTube session and everything. Thank you so much.